Trump just threatened to slap a 25% tariff on 8 European countries unless they hand over Greenland. Not for trade balance, not for industrial policy, but for a piece of land instead. They call it Tariff 2.0, and some might even frame the following weeks as the best buying the dip opportunity. Look, if you're short on time or you refuse to listen to some random guy with a cat-themed channel name, the key takeaway is this. Markets have been trained to treat Trump tariff threats like a crying wolf situation, the taco trade. But when the objective shifts from economics to geopolitics, from trade terms to territorial sovereignty, that pattern can break. And if you're positioning your portfolio assuming the usual script, you might want to stick around. Hey, I'm DataCat. If you're new here, welcome. I should probably explain myself a bit since, this channel's only been around for about 6 months now. I'm a former corporate analyst, spent years inside a Fortune 50 company, crunching numbers, building models, sitting through meetings that could have been one Slack message, you know how it is. Eventually, I traded the corporate grind for lasers and keyboards while my actual cat judges me silently from across the room. He's not impressed. Cats never are. But whomever is watching this, I hope you are not as mean as my cat. And if you find this useful, maybe consider subscribing. No courses to sell you, no premium Discord, just a guy and his spreadsheets trying to make sense of markets. Alright, let's get into it. So what exactly happened? Over the weekend, yes, the weekend again. Trump publicly announced a new round of country-specific tariffs, but this time a bit different. He tied them explicitly to European opposition to the US purchasing Greenland. And here's the breakdown. Starting February 1st, a 10% additional tariff on, quote, any and all goods sent to the US from Denmark, Norway, Sweden, France, Germany, the UK, the Netherlands, and Finland. That's 8 countries. And then, if there's no deal for the, again, I'm quoting here, complete and total purchase of Greenland, that tariff steps up to 25% on June 1st. Now, it's still unclear whether these stack on top of existing US tariffs, which are already sitting around 10 to 15% for some of these countries. So we could be looking at cumulative rates of 35 to 40%. That's significant. There's also a legal question mark here. Multiple reports indicate Trump is invoking economic emergency powers that are currently under US Supreme Court challenge. So the entire tariff architecture might be legally contested. But remember, markets don't wait for court rulings. They simply price in uncertainty immediately. And here's what makes this different from your typical tariff spat. This isn't framed as anti-dumping. It's not about protecting steel workers or reducing trade deficits. It's tariffs as political coercion to force movement on sovereignty, on territory. That's a different animal entirely. It's like, imagine your cat knocking things off the table, not because she wants food, but because she wants you to acknowledge she's the real owner of the house. Same energy, except with billions of dollars at stake. So how is Europe responding? And this is where it gets consequential. Europe's initial framing has been to call this political blackmail. And their retaliation posture isn't the usual, we'll tariff your bourbon and your Harley-Davidson's approach. They're signaling something broader. Reports indicate discussions around retaliation totaling about $108 billion. And these aren't just symbolic consumer goods tariffs. Europe is hinting at tools that hit where the US actually cares. Market access, government procurement restrictions, regulatory levers. The EU also has something called the anti-coercion instrument. It's designed precisely for situations where a trading partner uses economic pressure for political ends. If the EU believes that giving in here rewards coercion, they have both the tools and the political incentive to respond forcefully. And there's a unity angle here too. If Denmark, or any single country, is seen as being bullied into a territorial concession, the rest of Europe has strong reasons to back them up. Now let's look at what markets are actually doing. Even before US cash markets reopened, we saw classic tariff shock positioning, while the futures market suggests a textbook risk-off behavior. Equities down, safe havens up, but the commentary around it is revealing. Analysts aren't just worried about tariff math, the direct cost calculations. They're worried about NATO alliance fracture risk and policy unpredictability. That tells you what the marginal trader fears most. Not the tariff itself, but what it signals about geopolitical stability and the reliability of traditional alliances. That's a different kind of risk premium. Alright, so here's where I want to offer a slightly different angle than what you might hear elsewhere. Historically, the taco trade has been, well, pretty reliable. Liberation Day tariffs, followed by a 90-day pause. Threat to raise EU tariffs to 50% delayed. China tariffs pushed up to 145%, cut down to 30% during a pause. Even Fed Chair brinkmanship reportedly softened after investor pushback. So mechanically, traders have learned to play this loop. Headline escalation comes out, equities drop, volatility spikes, gold goes up. Then hints of negotiations or carve-outs emerge and you get a sharp rebound, the taco bit, rinse and repeat. As a matter of fact, by the time this video is out, the market might have digested this view and recovered from the pullback. Ha! And I get it. If you've traded this pattern successfully for a few times, your conviction builds. Social media is already saying buy the dip. And look, having conviction is good. But I'd encourage you to think about 3 structural reasons why this episode might be different. First, the objective is geopolitical, not transactional. Walking back a tariff threat is relatively easy when the goal is we want better trade terms. It's much harder when the stated goal is sovereignty control and national security. Trump's own framing repeatedly invokes Russia, China, and strategic necessity, including missile defense logic. You can't really half-walk back a territorial claim without looking weak. Second, Europe has credible non-tariff retaliation tools and a unity incentive. This isn't just about matching tariff for tariff. If they believe capitulation rewards coercion, they have reason to escalate beyond symmetric trade measures. That increases the probability of a genuine standoff rather than a negotiated off-ramp. Third, and this one's underappreciated, uncertainty itself is the economic weapon. Even if final tariff rates end up lower, persistent threat cycles chill investment and business planning. The IMF has explicitly warned about this. It's an uncertainty tax that compounds over time, regardless of whether the tariffs actually land. So yeah, the taco trade might work again, but the risk-reward is different when the underlying game has changed. Now you might be wondering, okay DataCat, why does Trump even want Greenland? Is it oil, like Venezuela? Not exactly. Greenland may have large hydrocarbon potential. There's a USGS estimate of around 31 billion barrels of oil equivalent in onshore northeast Greenland, including ice-covered areas. But that's potential, not producing reserves. And importantly, oil and gas extraction is currently banned in Greenland for environmental reasons. So what is the actual value? 2 things. 1. Critical minerals and rare earth elements. Greenland ranks 8th globally for rare earth reserves with about 1.5 million tons. There are major deposits, but, and this is a big but, no rare earth mining has actually taken place there to date. There's local opposition, permitting challenges, and basically no infrastructure. 2. Geostrategic position. Greenland hosts Pituffik, formerly Thule Air Base, which is critical for US missile defense and Arctic operations. So if you're asking what Trump is actually buying with Greenland, I'd say the strongest case is Arctic strategic position plus long-run critical minerals optionality, not near-term oil cash flow. And from an investing perspective, this does mean something for the rare earth industry and related equities. But we're still early. This needs to be monitored as it unfolds rather than traded aggressively right now. The thesis is there, but the timing is uncertain. So what's the actual takeaway for your portfolio? I'm not here to tell you to panic sell or to heroically buy the dip. What I am suggesting is this. Be aware that the taco playbook has limits. When tariffs shift from economic bargaining chips to geopolitical leverage, the off-ramps become narrower and the escalation paths become wider. If you're holding European exposed positions, understand the tail risk isn't just tariff math. It's alliance fracture and policy regime uncertainty. If you're looking at safe havens, gold's move makes sense in this context, but don't chase it purely on momentum. And if you're watching the rare earth space, yeah, there's a long-term thesis building. But long-term means long-term. Don't mistake a geopolitical headline for an immediate catalyst, but I will certainly keep an eye on those companies for you in the following weeks. Alright, that's the brief breakdown. If you found this useful, I'd really appreciate a like. It helps the algorithms show this to other people who might care about this stuff. And honestly, for a small channel like this one, every bit of engagement matters more than you'd think. If you want more of this kind of analysis, data-driven, a little skeptical of mainstream narratives, occasional bad cat jokes, consider subscribing. I put these out regularly, and I try to focus on things that actually matter for your money rather than just chasing whatever's trending. Thanks for watching. Stay curious, stay skeptical. DataCat out, and I'll see you in the next one.